Welcome to the Depth Dive. Today, we're really cracking open TransDigm Group's latest financials. We've got their Q3 2025 Form 10Q and their recent press release right here. Our mission, as always, is to cut through all the jargon, the complexity of these filings, and really pull out the key insights. What you actually need to know about how TransDigm's doing, their big strategic plays, and what it all might mean for aerospace and defense. Basically, your shortcut to getting up to speed. And well, the headline numbers look pretty strong, but as we dug in, we found this interesting twist, real strength, but also a surprising weak spot in one market that's kind of shaping their outlook. Let's get into it. So, looking at these reports, what was the first thing that really jumped out at you? The big picture.
Yeah, well, the top line growth is immediately pretty striking. TransDigm pulled in net sales of $2,237 million for the third quarter. That's up a solid 9.3% from last year. And if you look year to date, so the 39 weeks ending late June, net sales hit $6,394 million. That's up over 11%. And it's not just the growth itself, it's how consistently they seem to manage these kinds of increases.
Wow. Okay, those are definitely big numbers. How did that translate down to, the bottom line profitability?
Right, so that strong top line really flowed through. Net income for Q3 came in at $493 million, up almost 7%. And year to date, even better, $1,465 million, which is a jump of over 17%. Earnings per share followed that trend, $8.47 for the quarter, up 6%, and $24.31 year to date. Although it's worth mentioning that year-to-date GAAP EPS number was actually pulled down a bit, about 0.83 cents a share, because of some dividend equivalent payments they made earlier.
Okay, so strong growth, sales, net income. But with TransDigm, there's always this metric they focus on, right? Investors, too. EBITDA as defined. What's that telling us?
Exactly. Yeah, their EBITDA as defined, which is it's a non-GAAP measure, but really key for them. It hit $12,217 million in Q3. That's up 11.5%. Year to date, $3,441 million, up nearly 14%. And maybe more importantly, look at the margin. Their EBITDA as defined margin was 54.4% for the quarter. That's up 110 basis points.
Wow, 1.1 percentage points.
Yeah, and 53.8% year to date, up 130 basis points, or 1.3 percentage points. So what EBITDA as defined does for TransDigm, it basically pulls out interest, taxes, depreciation, amortization, plus some other things like stock compensation, currency fluctuations, acquisition costs. It's meant to give a clearer view of just the core operational performance. It's a really crucial indicator for them internally and externally. Though, like any non-GAAP number, you have to remember it's not exactly cash flow you can use for everything, like paying down debt.
Right, but still over 54% margin. That's incredibly high. It really speaks to their model, their pricing power. So beyond just selling more stuff, what's driving these profit numbers? Why are they looking so good?
Well, the higher net sales are the main engine for sure, but it also really reflects how they stick to their value-driven operating strategy. It's their core playbook. They also had lower one-time costs this quarter from refinancing and acquisitions compared to maybe previous periods. Now, on the flip side, they did have higher interest expenses, which, slightly offset some of those gains. That's something to keep an eye on.
Okay, got it. So strong overall picture. Now, this is where it gets interesting for me. How much of this growth is like homegrown organic versus coming from all the companies they keep buying?
That's a really good question. And the breakdown, it shows a pretty healthy mix, actually, which kind of speaks to their whole strategy. Organic sales growth, so sales from businesses they already owned, was up a strong 6.3% in Q3 and 6.6% year to date.
Pretty solid.
Yeah. And then acquisition sales growth, that's the boost from companies they bought in the last year, added another 3.0% in Q3 and 4.5% year to date. So you see both things working. The core business is growing,
Yeah.
and the acquisitions are adding on top.
Okay, so let's dive a bit deeper then. Where specifically is that revenue coming from? Which markets are firing on all cylinders?
Well, the commercial aftermarket was definitely a bright spot. Really strong performance there.
Yeah.
It's mostly driven by, the continued strong demand for air travel. More flying means more maintenance and parts.
Makes sense.
Yeah, so specifically in their power and control segment, organic commercial aftermarket sales were up 3.0% in Q3. And in the airframe segment, even better organic commercial aftermarket jumped 8.1%. Overall, year-to-date, commercial aftermarket sales are up a solid 9.5%. And the defense market was also showing real strength. Power and control defense sales up 10.1% in Q3. Airframe defense sales surged 24.6%.
Wow.
Yeah. So year-to-date, total defense sales grew 12.3%. They put that down to continued improvement in U.S. government defense spending finally flowing through. So yeah, pretty strong performance in those two big areas.
Okay, aftermarket and defense looking good, but now that sort of unexpected dip you mentioned earlier, what happened with commercial OEM?
Right, this is where we see the surprise, the anomaly.
Hmm.
Q3 commercial OEM sales, that's original equipment manufacturer. Parts for new planes actually decreased by 7.0%.
Decrease. Okay.
Yeah, and year-to-date, they were down 3.9%. So
Hmm.
this segment definitely fell short of what they expected. And they pinned it on lower than anticipated build rates from the big manufacturers, Boeing and Airbus, and also inventory destocking happening down the chain. They specifically mentioned things like ongoing supply chain and labor problems, the ripple effects from the Boeing machinist strike, and Airbus also having trouble really ramping up its production as fast as hoped.
Hmm. So it's not just a blip, it points to those bigger, persistent issues in the supply chain and labor markets, doesn't it?
Exactly. Even a powerhouse like TransDigm isn't totally immune. It shows how much they rely on that stable aftermarket business to kind of smooth over these OEM bumps.
Yeah, it's a stark reminder. So with all that going on, especially the OEM dip, how did their overall gross profit hold up, and what drove that?
Well, despite those ODM headwinds, gross profit actually increased. It hit $1,332 million in Q3, up from $1,220 million last year. And year to date, it climbed to $3,841 million from $3,413 million. The gross profit percentage also improved year to date, ticking up to 60.1% from 59.3%.
Okay, so margin expansion even with those issues.
Right, and that was even with some foreign currency headwinds in Q3. The dollar weakening against the pound and euro actually hurt their cost of sales a bit. They credit the improvement mainly to that three-core value-driven operating strategy, again, focusing on profitable new business, cost improvement, value pricing, and also just spreading their fixed overhead costs over more production volume overall.
Right, that operating model seems absolutely key. But TransDigm isn't just about operations. They're famous for M&A, always buying companies. How do these big acquisitions fit into the picture?
Oh, yeah, they've been very active as usual. Just recently, end of June, they inked a deal to buy Simmonds Precision Products from RTX. That's about $765 million in cash. Simmonds makes things like fuel sensing systems, health monitoring for planes, pretty critical stuff.
Uh-huh.
Then, literally the day after the quarter ended, July 1st, they closed on acquiring Servotronics for around $133 million. They do servo controls, advanced tech components.
Okay, so adding more specialized tech.
Exactly. And these are just the latest. These build on a whole string of acquisitions from the last fiscal year. Remember, Raptor Scientific, CPI's electron device business, SEI, FPT, Extent product lines. It's quite a list.
They really are constantly buying.
They are. But what's key is it's not random. They have this incredibly consistent strategy. They look for businesses making highly engineered proprietary aerospace parts, usually in niche markets. And this is crucial with significant aftermarket potential. The whole goal is to plug these companies into their operating model, find profitable new business, improve the cost structure, implement value pricing, and they're playing the long game. They want products that generate recurring aftermarket revenue over the entire life of an aircraft, which they figure is, 25 to 30 years.
So it's very strategic. It's not just buying revenue today, it's buying decades of potential profit. Okay, but how do they pay for all this and manage their overall finances?
Right. Their capital management is also pretty disciplined. They just did a big debt refinancing move. Back in May, they issued $2.65 billion in new notes, 6.375% due in 2033. Then in June, they used that cash, plus some of their own, to pay off the same amount of older notes that were due in 2027 and had a lower coupon, 5.50%.
Paying off lower rate debt with higher rate debt. How does that help? Oh, wait, reduce refinancing costs in Q3? Okay.
Well, it pushes the maturity way out, gives them more runway.
Yeah.
And yes, maybe some accounting benefit on costs for the quarter.
Yeah.
They also just tweaked their receivables facility in July, bumped up the borrowing capacity to $725 million, extended it to 2026, and actually got a slightly lower interest rate on that piece. And looking at their overall debt, about 75% of it was fixed rate as of the end of June. So they're clearly trying to limit their exposure to rising interest rates in the near term.
Makes sense. So managing debt, but also returning cash, right? Share buybacks.
Yep, they bought back shares too. In Q3, about 105,000 shares for roughly $131 million. Year to date, it's over 400,000 shares for around $500 million. They still have about $788 million left on the repurchase program they authorized back in 2022. And we should remember that Huge special dividend they paid last October, $75 a share. That was over $4.2 billion going back to shareholders, though no new dividends were declared in this recent period.
That $75 dividend was massive, so they have this, like, clear hierarchy for using cash.
They do. They state it pretty clearly. First priority is capital spending on their existing businesses. Second is acquisitions. Third is special dividends or share buybacks. And last is paying down debt ahead of schedule.
That seems very structured. Does that ever maybe limit them if a really unique opportunity pops up outside that order?
That's a fair question. But while they have the hierarchy, their financial position gives them a lot of flexibility within it. They had almost $2.8 billion in cash sitting there at the end of June, plus another $856 million available on their credit line. So total liquidity is over $3.6 billion.
Okay.
And crucially, they don't have any major debt coming due until August 2028. That gives them a lot of breathing room to pursue acquisitions or return capital when they see fit.
Got it. So plenty of firepower and flexibility. Okay, let's look ahead then. How are they adjusting their forecast for the full fiscal year 2025? Sounds like that OEM dip must be factoring in.
It absolutely is. So
Yeah.
it's a bit mixed, actually. They've revised their guidance for EBITDA as defined and adjusted earnings per share upward at the midpoint.
Oh, okay. Better profit outlook?
Yeah, but on the flip side, they've revised their sales guidance slightly downward. The midpoint is down by about $60 million for the full year.
Okay, so profit outlook up, sales outlook slightly down, and I assume that sales adjustment is straight back to the commercial OEM issues.
Precisely. They stated it's primarily due to those lower than expected commercial OEM sales. Again, citing the slower build rates and the inventory destocking, that whole dynamic with Boeing, Airbus, supply chains, labor. It's clearly having a tangible impact on their full-year sales forecast now. But despite that specific headwind, their growth assumptions for the other big markets are holding steady. Commercial OEM revenue growth is now forecast to be basically flat to maybe low single digits.
Right.
But they're keeping commercial aftermarket growth in the high single-digit to low double-digit range. Same for defense, high single-digit to low double-digit growth still expected there.
Okay, so still strong growth expected from aftermarket and defense, just moderated overall by OEM. What are the actual projected numbers then? Ballpark?
Yeah, so at the midpoint of their new guidance for the full fiscal year 2025, net sales around $8.79 billion, still up almost 11% from last year. Net income projected at $1.96 billion, up over 14%. Earnings per share potentially hitting $32.80, which would be a big jump, 28% year over year. EBITDA, as defined, forecast at $4.725 billion, up over 13%, with that margin holding strong around 53.8%. And adjusted EPS forecasted at $36.74, which is up about 8% from fiscal 24.
Okay. So let's try and wrap this all up. TransDigm delivered a pretty strong Q3 overall, really powered by that commercial aftermarket and the defense side doing well. They're still aggressively pursuing acquisitions, but it seems very strategic, focus on that long-term aftermarket model. And they're managing their capital very actively, refinancing debt, buying back stock. The main caveat, the headwind, is definitely that commercial OEM sector softness, which has just nudged their full-year sales forecast down a bit, even while the profit outlook improves slightly. It's quite a picture of navigating a complex market.
Exactly. And it really leaves you with this thought, doesn't it? You know, in a market where things can change quickly, these short-term dynamics.
Yeah.
How well does TransDigm's really unwavering long-term strategy that focus on proprietary parts with lots of aftermarket actually position them to ride out this kind of turbulence? And maybe what does that signal about the resilience of these specialized aerospace suppliers in general?
That's a great question to ponder. How do companies balance that aggressive growth and capital return playbook with the messy realities of supply chains and market swings in an industry like aerospace? Something definitely worth thinking about. Thanks for joining us for this deep dive.